Good morning. CRE faces new pressures as the war in Iran escalates. And the commercial real estate market doesn't operate in a vacuum, and it reacts fast to macroeconomic shocks. And right now, the escalating conflict in Iran is introducing a new layer of pressure across the entire CRE landscape. And I hope this ceasefire works. From rising energy costs to capital market volatility, this isn't just geopolitical noise. It's a structural shift that investors, owners, and business operators need to understand. So, the real driver here is that energy costs are reshaping demand, and oil prices are the first domino. And as fuel costs rise, transportation and logistics expenses increase across the board. And that changes how companies think about real estate and their operations. So, what this means is that companies prioritize proximity over scale, and distribution networks shift towards last mile logistics, and as well, demand increases for urban infill assets. Translation: industrial real estate, especially near population centers, is gaining a structural advantage. Industrial and defense manufacturing. So we have some selective tailwinds here. And geopolitical tension historically leads to increased federal spending, particularly in defense and infrastructure. So, what to expect? Some growth in aerospace and defense manufacturing hubs, as well as increased demand for specialized industrial facilities, but also job creation in manufacturing heavy markets. And for investors, not all industrial is equal. Tenant type and industry exposure now matter more than ever. Let's talk about Houston, the quiet winner in a global disruption. And this is where your local advantage comes into play. Energy driven markets, especially Houston, stand to benefit from rising oil prices. So, why Houston wins? Increased drilling and production activity, job growth tied to energy and logistics, but also spillover demand into industrial, into workforce housing, into retail near growth corridors. The bottom line: Houston isn't just scalable, it's positioned for relative outperformance in this next cycle. Let's talk about EV and infrastructure, which is also a secondary ripple effect. And higher fuel costs tend to accelerate long term shifts towards alternative energy. So, watch for renewed investment in EV infrastructure, but also demand for manufacturing and charging facilities, as well as growth in logistics and energy crossover assets. And what this does is it creates a niche of opportunities in land development, in industrial conversions, and infrastructure driven CRE plays. So let's talk about capital markets and the real risk layer. And this is where deals get impacted first. Geopolitical instability will introduce some investor hesitation, wider bid-ask spreads, but also delayed transaction timelines. And some of those key pressures could be rising interest rates or inflation volatility or uncertain exit pricing. And the translation there is if liquidity tightens, deals don't die, they just stall and take longer. So tenant demand is starting to cool, and we're already seeing early signals across certain sectors. So in office, we're seeing some expansion delays, increased lease flexibility demands, and in retail, we're seeing consumer spending soften a little, and tenants are becoming more cautious. And in multifamily, absorption slows if job growth weakens, and rent growth faces pressure. The point is, this is not a collapse, it's just a repricing of expectations. And here's the strategic takeaway for the day, and structure is going to win again. And what this does, this environment reinforces a core principle. The market isn't breaking, it's just resetting. So some winning strategies right now would be to focus on cash flow durability, underwrite with conservative exit assumptions, and prioritize location efficiency. So for logistics and population proximity perspectives, those are two high item checklists, but also to maintain liquidity and reserves. And external shocks don't destroy real estate, they reallocate opportunity. And the investors who win in this cycle won't be the ones chasing the deals. They'll be the ones who are understanding the macroeconomic shifts and then structure deals correctly and move when others hesitate. So, my call to action for you is if you're evaluating an acquisition or refinancing risk or a repositioning strategy in today's market, walk through your deal like a lender would. And that's all starts with a conversation. Please visit my website, houstonrealestatebrokerage.com, to figure out how to get a hold of me. Reach on out. Love to have a conversation to see how we could help better your world. My name is Bill Rapp. Hope you have a good day.